Well, welcome once again, guys, to the Middle Class Investor. This is Seth. It is January 28th, and we're looking at a chart of the S&P 500, and just keeps going higher. Of course, there's a lot of news right now about the market because the Dow breached 20,000, and it looks to me like it's gonna go higher still. We're in this channel, and it's been respecting this channel the whole way up. So there's no reason to think that it won't continue to do so. So I would say that next week probably gonna hit the top of this channel, and then maybe pull back to the mid channel, and then probably hit it again up in here. So there's just more left here. Um, um, it appears so. We just need to respect that. So if you're worried and you're thinking you want to get in, I mean, you could right here, but we should have a pretty good pullback into this midline um, uh, after we touch this line again. So it would be kind of like this one right here. I'm not sure you can see that one. Let me back up and I'll show you what I'm talking about. Well, sort of like this one right here, where we touched the midline and rallied up, but didn't touch the channel there. But I think this next rally after we get a little pullback, first we're going to go higher, but we'll get a pullback probably around to this midline, and then we'll get a new rally. And we're probably going to get market's probably got another 50 or 60 or 70 points in it. You know, there's a lot of interesting, a lot of it's interesting because a lot of people are excited about the market, but then other people are saying, uh, be careful. And I guess I'm kind of in the be careful camp because um, price to sales are as high. So you normally hear about price to earnings or earnings ratios, um, but there's another one that's less followed. That's price to sales, and that's just the price of the stock as it relates to the sales of the company. And the reason this is important is because, the price of the stock has to be based on something. It has to be more valuable in the future because people think sales are increasing, but sales are actually decreasing, and this earnings season is no different. I mean, they've been decreasing now for a while. So, and right at this moment, the price to sales ratio is as high as it was in 2000 at the .com run up. So, that means there's a lot of risk, and we have other risks too. I mean, we're going to talk about the bond market here in a second. In fact, let's look at volatility first. A lot of times we like to look at volatility just to confirm, the direction of the market. And you can see here volatility has been very low. I mean, 10 and a half on volatility is extremely low. And a couple weeks ago, I didn't have a video last week, but a couple weeks ago I talked about these lows in here probably not being pierced, but here we are below those lows. So that is very unusual. In fact, let's go back. I don't know how far back we have to go. Let's go back 20 years. Okay, so back in 2007, the volatility got to 9.39. So, that's pretty low, way back here in 2007. And then, of course, you saw how volatility ran up when we had the financial crisis. So we just have to, period. I know this sounds kind of cliche almost, but periods of high volatility follow periods of low volatility. And so the question then becomes, well, what is low volatility? And you can see back here, we had some lows around the same area, 10.2, in 2014. We spiked up a little bit in 2015 and sold back off, kind of came back down. But if this volatility gets much lower, it'll be the lowest on record, I think. So these are just things to kind of think about, not things to worry about so much, but just think about as you're putting new money to work and things like that. All right, let's look at we'll look at the short-term Treasury yield. Of course, we said as long as we stayed above this line, the Fed would raise rates, and of course they did raise rates. And I suspect with the next run-up in yields on the 10-year, the short-term yield is going to go even higher still, and the Fed will keep raising rates. It looks like to me, we've had a good run-up in the yield, the 10-year here. And we'll probably, I think I've said this before, we'll probably get a pullback into this area around this gap. You get this gap here, this zone right around here, around the gap. And then we should get a new run-up in yields. And this run-up in yields should cause the short-term yield to make another leg higher. That's the short-term yield is this 13-week Treasury, which is the $ IRX. And once that, once the 10-year turns around and starts going higher, this will probably resume its path higher as well. Along with the 30-year Treasury, all the yields are now starting to move up. So this, maybe 100 times, but if you're in bond funds, be careful. Maybe look at trying to get out of some of those bond funds, especially with this next pullback. If we get a decent pullback here into this area around 2.1, 2.2, that's a good place to kind of take that money off the table. Maybe even get back here to 1.95 or so. So be looking for that. It'll probably accompany some sort of downturn in the market. So let's go back and look at the S&P 500. So we just talked about that's the spiders. Let me do the index. So I've got a channel on here. We talked about maybe this going a little higher and then pulling back here to the midline. And this pullback to the midline will probably lead, push money into the bond market, lowering yields. So that's probably when you'll need to make that adjustment, is when the market pulls back and your bond fund is increasing in value. You want to look at this dollar TNX for a move back to at least 2.1 and maybe even 1.95. All right, so let's take a look at Germany. Both Germany and Japan and the UK have all broken out of these downtrend lines. It could be counter trend, but probably not. It's probably going to run up eventually into new highs, probably around this box that we had. We've had this box on here forever, but let me scoot it over. It's about right there. And so we'll probably run up into that area before the market pulls back again. So we're entering a period of time when there's probably going to be some exuberance in world markets, and there's already it's been that way in our market ever since the election. So, and it looks like maybe we're kind of pulling some of these other markets along. Here's Japan. The United Kingdom is more sideways. You can see here the market just looks more sideways to me. It looks kind of in this box area, but it did break out of this downtrend and did so fairly strongly. So we'll continue to watch the UK and these other markets in general um, for evidence that something's changing. Um, let's see. Let's go look at the dollar and gold and um, let's see. This is silver. Let's look at the dollar first. So the dollar's had quite a run here, and still hasn't hit that box that I've been expecting it to run up into. So I'm guessing that there's one more push higher in the dollar here. Could take us to 107 or so on the dollar. That'll probably correspond with a fall in the euro. So the dollar is about done going up, which means the euro is getting close to being done going down. Now I'm short the euro right now because I think it's going to make one more low. So we'll zoom in and look at that. I took a position in the euro last week, somewhere in here, maybe there, because when it breaks down through a line like here, and then it retests. So it retested that line and then started to sell off. So I went ahead and entered, and I'm looking for the euro to come down into this area here. So it's a pretty good trade, probably. I don't know, 300, 400, 500 pips, something like that. I'm not sure. I didn't actually count it. So, but look for the euro as the euro falls for the dollar to make maybe one more new high. And then if you look at this trend, that's about it. From the fall of the euro. Parity's down here around this red line. I thought we were going to get to parity, but I don't know. I don't know if it can fall that far. I mean, it can. It certainly could fall that far. Whether it actually does or not, that's a whole other story. So I'm not going to try to trade it that far because that's I'm going to go ahead and take profit here at the old lows. Let's look at oil real quick, and then we'll go look at gold. Oil's been grinding its way higher. This area right in here, to me, looks like it's trying to top here. So, the next stop for oil is going to be down here, probably not this far, but probably like right in here. Whoops, sorry about that. Let's try that again. Probably, two lows just below this pivot here, and then a bounce, and then, a resumption of the fall. I still think oil is going to go lower. It's going to take out these lows down here. That's probably not a very popular view, but that's where I think it's likely headed. This looks fairly counter-trendish to me. Now, I mean, it could go higher. In fact, we got another resistance area here. But to me, this move here this first move would have gone a little higher if it was the end of the trend. So, in other words, this move right here would have gone to this box here directly rather than stopping here. So this looks more counter-trendish to me, which means it should roll over shortly and make new lows. Probably down here below 25. We've got this box down here that goes from about 23 to 18. Shouldn't go lower than this, though. Shouldn't go lower than 16 or so on oil. All right, let's look at gold. A couple weeks ago, I was talking about gold, temporarily ending this fall and starting to make its way up into this area here. Now I think we got a little pullback happening in gold, probably for the next week or two. And then, again, it looks like a good place to buy gold. looking for a move up to this 1450 area. Same thing with silver. Silver just looks slightly different. If you just watch, excuse me, if you just watch one of the charts, it's probably good enough because they move pretty much together. Silver tends to move more, but I think we're going to be seeing silver up here around this area, around 22, 23, maybe even higher, maybe around 24 in this next move up that's going to go this way. So, you might, if you're going to buy physical gold or silver, you might wait for a small pullback, maybe the next week or two, and then buy for this move up into here. I still think silver and gold are going to go lower in the next several years, but near term, if you're just trying to get in gear with this larger trend, what do I mean by larger trend? I mean, if I pull this up, this is the larger trend, this move here. So if you're trying to get, we've got some counter trend thing happening here. It might even go higher. It might go up here around 30 or so, but then roll back over and probably come down here to $7 or $8. But that's going to take several years. So, and we've talked about the risks of trying to wait for that number. Certainly you could buy more if it's available, that number. The problem is that either it might not be available or it's so hard to find that the commissions are really, really high. And so you end up not getting a good total price here. Yeah, you get the spot price, but if you had to pay 4, 5, 6, 7, 8, 10% in commission, you're paying a lot of money to get that silver at that price. So anyway, just wanted to point that out. We talked about oil, we talked about gold. We can look at the euro, US dollar. If I can find it, here it is. So again, we're looking for the euro to pull down here, and correspondingly the dollar to rise up here to above 105. The markets look really strong right now. I mean, I can't argue. They're really at extremes, historical extremes. But that happens all the time. I mean, the market can be at historical extremes for long periods of time. So everybody has to make their own decision. But I do think we're at a point. Let me go to like a 2-year and just zoom in here a little bit. Let's use a daily chart. Again, I think we're likely to see some sort of rally up early next week, a pullback that might take us, close to this midline, and then a run up back to this trend line. I don't know that we'll actually get there in this first little move. We might move a little higher and then pull back and then run past this point and this point. And so when you look at that, that's let's see what that is. That's 2340 on the S&P 500 and probably like 21,000 on the Dow, so or 20,600 or something like that. So but we are going to see some increased volatility first, and the next wave up probably won't be definitely won't be as strong as this wave. This wave was really strong after the election. When you start getting toward the ends of these moves, the strength of the waves get weaker and weaker. So we would expect that to happen here. But I would say 2350 is probably doable. And, it's probably going to be April or so, May, uh, before we see those highs. So I would say in April and May, your spidey senses probably need to perk up a little bit more, and let's try to avoid the next big bear when it comes. If we can avoid these bear markets, you don't even have to be right as much on these uptrends. You just have to get in and stay with them, and then be out during the bear markets, and you're going to make lots of money. You're going to retire very well one day. So, all right, everybody, that is it for this week. If you've got any comments, feel free to put those on the YouTube comments section. I haven't been very active on Twitter, but you can go connect with me on Twitter at investorclass. Sometimes I do forward interesting articles from like Zero Hedge or from Contra Corner, which is now his name escapes me right now, or KC Research or something like that. So if you want to connect with me on Twitter, I'd be happy to be connected to you. I can also answer questions there if anybody's got any questions. Of course, the answers can only be like 140 characters, so it's not going to be that in depth. But all right, everybody, that is it for this week. Thanks for coming in, and we'll be back here next week for another middle class investor extravaganza. All right, take care, everybody. Bye.